So the mortgage industry has a problem. Well, if we're being honest, it has a few problems. But there's one specific glaring flaw that's ruined the home buying experience for millions of people for decades. If you've ever applied for a mortgage, you already know exactly what I'm talking about. You sit down at your computer, you fill out an application, and you hit submit, and the second your credit is pulled, your phone becomes entirely unusable. It starts ringing and ringing, 50, 60, sometimes 100 calls a day from random call centers all over the country trying to sell you a loan. It's the real world equivalent of getting hit by a massive spam attack. In the industry, these are called trigger leads. But starting today, March 5th, 2026, the federal government is officially rolling out a patch for this bug. It's called the Homebuyers Privacy Protection Act, which makes this practice illegal. I'm Chris Choe. I'm a mortgage broker based in the DMV, and today we're going to be going through the full breakdown of this new law. We're going to take a look at why your data is being sold in the first place, the major loophole the banks left in this new legislation, and most importantly, why stopping the spam calls does not actually solve the biggest vulnerability you have when buying a home. So let's get into it. To understand why this law is such a massive deal, you have to understand the mechanics of how your data was being handled. For the uninitiated, when you apply for a loan, your lender has to pull your credit. That data comes from the big three credit bureaus, which are Experian, Equifax, and TransUnion. But for years, these bureaus haven't just been passively holding your credit score, they've been actively monetizing your behavior. The moment a credit is pulled, it triggers an alert in their system. The bureaus take your name, your phone number, and the fact that you're actively shopping for a mortgage, and they package it up and sell it in real time to the highest bidder. Those bidders are usually massive high volume call centers. Their entire business model is based on speed. They don't know your financial goals. They don't know what kind of house you want in Bethesda, Arlington. They just want to throw you a low teaser rate at you before anyone else does. Under this new law, this completely stops. Credit reporting agencies are now federally prohibited from selling your trigger lead data to creditors. The only way a company can get that lead is if you explicitly opt in, or if they meet a very specific set of conditions. Which brings us to the catch. You see, whenever sweeping legislation like this gets passed, there's almost always a loophole. And in this case, it's a big one. The law states that a trigger lead can still be generated and sold to a creditor if that creditor already has qualifying existing relationship with you. What does that mean in plain English? It means your current bank, if you hold a checking account, a savings account, or a current mortgage with a major retail bank, they are legally allowed to reach out to you the second your credit is pulled. So today, as this law goes into effect, your phone won't ring 50 times, but it might ring once or twice. And it will be your current bank calling to offer you a preferred member pricing. This is where you have to be analytical about who you hire. A retail bank represents themselves. They have one set of products, and their job is to sell you those products. A mortgage broker's job is to analyze your situation and find the math that works best across multiple wholesale lenders. When your bank calls, you absolutely should hear them out. But understand that just because they have your checking account doesn't mean they have the best mathematical strategy for your mortgage. You should always demand transparency and compare the numbers. Here's the real issue I want to talk to you about today. This isn't the part that isn't making the headlines. The biggest danger of this new privacy law is that it's going to give homebuyers a false sense of security. People are going to think, great, the spam stopped. My privacy is protected. I have my standard pre-approval letter from my lender. I'm ready to buy a house. But let me be very clear. A standard pre-approval letter is just a piece of paper. In a highly competitive real estate market like DC, Maryland, or Virginia, that piece of paper carries very little weight. Why? Well, because a standard pre-approval is usually just the result of a quick credit pull and a brief conversation about your income. The lender hasn't actually verified your tax transcripts. They haven't audited your bank statements line by line. They haven't stress tested your file. To a seller, that standard pre-approval represents risk. It means there's a chance that halfway through your 30-day closing window, an underwriter is going to find an issue and the whole deal will fall apart. So stopping the spam calls is great for your peace of mind, but it does absolutely nothing to make your offer stronger when you're bidding for a home. So if a standard pre-approval is flawed, what's the alternative? What should you actually be looking for when you're hiring a mortgage professional? You shouldn't be looking for someone who just pulls your credit and hands you a letter. You should be looking for an advisor who takes heavily analytical approach before you ever step foot into an open house. You need someone who's going to audit your file against strict GSE guidelines. Well, GSE stands for government sponsored enterprises. These are the organizations like Fannie Mae and Freddie Mac. They write the rule book for conventional lending. So a true mortgage professional will look at your W-2s, your tax returns, your variable income, your assets through the exact same lens that a GSE underwriter will use later. They'll do the math. They'll calculate your debt to income ratio exactly to the decimal. They'll look for the red flags that cause delays, things like large unsourced deposits in your bank account or employment gaps. For example, here at OneRate, we call this process a purchasing power audit. As a broker, we don't officially underwrite the loan. That only happens after you've ratified a contract with the seller. But by running this rigorous audit up front, we simulate the underwriting environment. That's the benchmark you should be holding your lender to. You want to know exactly where the limits of your purchasing power is before you bid, not after. Now let's talk about the reality of the market. You'll probably hear real estate agents or other buyers talk about waiving your financing contingency to make your offer look as strong as a cash buyer. When you're interviewing a mortgage professional, pay very close attention to how they handle this topic. A responsible broker will never tell you to remove your financing contingency, and they will never encourage you to do so. A financing contingency is a legally safety net designed to protect your earnest money deposit if, for some reason, the loan can't be secured. Waiving it is a financial risk, and choosing to waive it 100% is your discretion as a buyer. And additionally, you should be extremely wary of anyone who guarantees your loan upfront. In the mortgage world, there is no such thing as absolute certainty until the loan is officially clear to close and the funds wired. What upfront underwriting does is it provides mathematical confidence. When your file is audited against the GSE guidelines early, you know that once you have a ratified contract, your file is clean. It's prepared to move as fast as humanly possible through the actual underwriting process because the obvious hurdles were already identified and solved. You aren't guessing, you're executing a planned strategy. So what's the final verdict on this new Homebuyers Privacy Protection Act? Well, it's a massive step in the right direction. It stops the most predatory practices in the industry and gives you the quiet space you actually need to plan your financial future without being harassed. But it is only step one. For your immediate next steps, here's what I want to recommend. First, understand that the rollout of this law might be a bit messy. Old data might still be floating around. If you want to put a hard lock on your privacy right now, go to optoutprescreen.com. It's the official centralized website run by the credit bureaus that allows you to opt out of unsolicited credit offers. It takes 2 minutes, it's free, and it works. Second, if you're actively looking to buy a home in the DMV and you truly want to understand the math behind your mortgage, so you can hold whichever lender you choose accountable, I've put together a completely free 19-minute educational masterclass. In that video, there's no sales pitch. I just pull up, talk to you, walk you through exactly how an upfront audit works. I show you how to read the Box A origination charges on a loan estimate so that you can spot the junk fees, and I explain how small adjustments to your liabilities can dramatically change your buying power. You can find that link to the masterclass in the description right below this video. So go check it out, learn the math, and take control of your process. I'm Choe. Thanks for watching, and I'll catch you in the next one.